Welcome back to Intelligent Investment Today, the podcast that takes a thoughtful, disciplined approach to the world of investing, with, of course, a particular focus on the principles of value investment. In each episode, we aim to apply the timeless wisdom of Benjamin Graham, teacher, mentor, and inspiration to Warren Buffett, to the challenges and the opportunities faced by today's investor. Whether you're just starting on your investment journey or are already a seasoned hand, our goal is always the same: to bring clarity, context, and Graham-inspired insight to a world that often prefers noise over knowledge. In this episode, we're going to be taking a deep dive into the UK stock market, a market that, to put it bluntly, has fallen out of favour with investors, both domestic and international. We'll be asking why it appears to be so unloved, what has contributed to its underperformance, and crucially, whether it presents a compelling opportunity for the value investor. We'll be looking at the bigger picture, political events, structural trends, investor behaviour, and we'll also examine what this means at the level of individual companies and valuations. So sit back, strap in, and prepare to engage with another lesson in value investing, and one that Benjamin Graham himself might well have found both timely and relevant. Let's begin with the glaringly obvious. The UK stock market has underperformed. And when I say underperformed, I don't mean marginally. I mean consistently and meaningfully over a sustained period of time, particularly when compared to the United States, but also against many developed markets across Europe and Asia. Let's have a look at the numbers. If you'd invested £10,000 in the S&P 500 back in 2010, reinvesting your dividends, your holding today would be worth somewhere in the region of £45,000. Do the same in the FTSE 100, you'd be sitting on something closer to 17 or 18,000. And that's not a blip, it's a trend. And as always in investing, where there's a trend, the temptation is to project it forward, to assume that what has been will continue to be. But as value investors, we're trained to look a little deeper than that, to challenge the narrative, to ask the question, why has this happened? Is it justified? And most importantly, what does it mean going forward? So let's begin with one of the most frequently cited reasons. That is Brexit. The UK's 2016 decision to leave the European Union marked a turning point in many ways, politically and economically. From an investment perspective, the most immediate consequence was uncertainty. And markets, as we know, despise uncertainty. Before the referendum, UK and US equity markets had tracked each other fairly closely over the preceding 15 to 20 years. But from 2016 onwards, their paths diverged sharply. The S&P 500 went on to reach new highs, driven by a mix of tech-fueled optimism, fiscal stimulus, and investor enthusiasm. Meanwhile, the FTSE 100 stumbled, range-bound, unloved, and overlooked. Now, regardless of your views on Brexit, and reasonable people can disagree on politics, it's hard to deny the economic implications. Leaving a free trade bloc that accounted for nearly half of our imports and exports was never going to be painless. Multinationals reconsidered UK headquarters, sterling weakened, and most significantly, international investors began to question the UK's place in the global investment landscape. The result, capital outflows, valuation compression, and a persistent Brexit discount across many sectors. But here's the thing. We're now several years on, the dust is starting to settle, and in that vacuum of attention, value often emerges. Brexit, of course, isn't the only reason for the UK's stock market woes. A more subtle but no less powerful factor is cultural. Simply put, British people don't really invest in stocks, or at least not to the same extent as their American counterparts. In the United States, around 60 to 65% of adults have some level of exposure to the stock market, often through pension plans, IRAs, or individual investing. In the UK, depending on which piece of data you take, the number is closer to 20%. And if you strip out workplace pensions and focus on individual share ownership, that figure drops even further. And just why might that be? A large part of the answer might well lie in our national obsession with property. From a young age, we're told that the ultimate financial goal is to get on the property ladder. Owning your own home is seen not just as a personal milestone, but as the most secure and respectable form of investment. And it's been a pretty successful one too. House prices in the UK have seen strong long-term growth, particularly in London and the South East. But here's the problem. With so much personal wealth tied up in property, There's less capital flowing into productive businesses, less demand for shares, less retail participation in equity markets. Contrast that with the US, where risk-taking is almost part of the cultural fabric. Stock ownership is normal. Taking a punt on a tech stock is part of the dinner table conversation. IPOs are national events. And that difference in mindset creates a vastly different investing ecosystem. Another key factor behind the UK market's malaise is the composition of the indices themselves. The FTSE 100, for example, is heavily weighted towards so-called old economy sectors. Energy, banking, insurance, mining, pharmaceuticals. These are mature businesses, often highly profitable, but lacking the growth narrative that excites modern investors. Compare that to the S&P 500, where the top names are Apple, Microsoft, Nvidia, Amazon, Meta and Alphabet. These are companies that dominate the headlines, drive innovation, and rightly or wrongly command sky-high valuations based on future potential. Now ask yourself, where are the UK's answer to these companies? Where is our Tesla, our Nvidia and our Google? The truth is, we don't really have them. Or when we do, think of ARM Holdings for instance. They tend to list in the US, where valuations are higher and investor appetite is stronger. Without exposure to the high growth themes of AI, cloud computing or biotech at scale, the FTSE 100 and even the FTSE 250 struggle to incite global investors looking for the next big thing. But here's where the value investor comes in. Because when markets become popularity contests, fundamentals are often ignored. We're in a phase right now not dissimilar to the late 1990s, where growth stocks and future-facing narratives command a significant premium. The US market especially has been driven by a small handful of mega-cap tech firms that have lifted the entire index. Take those top 10 performers out of the S&P 500 and you'll see a very different picture. Meanwhile, UK companies, less exciting, more boring, have largely been left behind. But boring, as we know, is often beautiful, especially when it's generating 7 to 10% dividend returns, steady cash flows, and trades at 10 times earnings. This is exactly the kind of environment in which a value investor should thrive. When sentiment is so overwhelmingly skewed in one direction, towards hype, momentum, and growth at any price, the unloved corners of the market begin to offer up opportunities. So where does all this leave us? If you're a growth investor, you may continue to prefer the US. The stories are compelling, the valuations are rich, the hype is alive and well. But if you're a value investor, someone who looks at earnings, cash flows, balance sheets and intrinsic value, the UK might just be your playground. You've got solid companies trading at discounted valuations, dividend yields that outpace inflation, a relatively stable economic backdrop, and a market that is still being ignored by the herd. In other words, a textbook value setup. And let's be clear, stock markets are cyclical. Sentiment shifts, capital moves. What's unfashionable today can be front page news tomorrow. And we've seen it time and time again. Dot-coms in 2000, financials in 2008, energy in 2020. Eventually, price and value converge. And when they do, those who are patient are usually rewarded handsomely. So to summarise, we can say that the UK stock market has underperformed for a number of reasons. Some justified, others more psychological or structural. Brexit created uncertainty and scared off capital. Domestic investors prefer property to equities. The indices themselves lack the glamour of Silicon Valley. And sentiment, more broadly, has shifted away from value and towards momentum. But beneath the surface, UK markets are offering something rare. Real businesses at real discounts, with real returns. And that's exactly where value investors thrive. As Benjamin Graham famously put it, the intelligent investor is a realist who sells to optimists and buys from pessimists. Right now, pessimism reigns over the UK market, which might just make it the perfect time to take a closer look. And that's it for today's edition of Intelligent Investment Today. I do hope you found our exploration of the UK stock market both informative and thought-provoking. If you enjoyed the show, please consider subscribing, leaving a review, or adding us to your playlist. It really does help others discover the podcast, and to make this as wide a community of like-minded investors as possible. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.